Good morning and welcome to TOI Japan Market Radio, December 2, 2025. I'm your host coming to you from Tokyo. This show is designed for global investors tracking Japan exposure, whether you're actively invested here or monitoring the market from abroad. Let's dive straight into today's session.
Thanks for having me. Looking at the headline numbers, we had a relatively quiet session for the main indices. The Nikkei 225 closed at 49,303.449, essentially flat at 0.0%. TOPIX also unchanged at 3,501, again 0.0%. But beneath that calm surface, we saw some notable divergence. The Mothers Index, which tracks smaller growth names, dropped 3.766% to 2044, suggesting some risk-off behavior in the high beta space. J-Rights were slightly softer, down 0.074% to 2026.0.
And on the currency side, how did the yen trade today?
USD JPY was marginally higher, up 0.08% to 156.052. So very modest movement, really range-bound. Elsewhere in commodities, gold priced in yen declined 0.446% to 15,630, while crude oil ticked up 0.561% to 59.17. Overall, it's a picture of consolidation across most asset classes, with investors clearly waiting for the next catalyst.
That consolidation theme makes sense given some of the big-picture uncertainties we're seeing. Let's start with a significant warning from the OECD today. They're flagging that global growth resilience could be tested by two competing forces: escalating tariffs and the AI boom. What's your take on how this matters specifically for Japan?
This is a critical framing for Japan because the country sits right at the intersection of both risks. On the tariff side, Japan remains heavily export-dependent, particularly in autos, semiconductors, and industrial machinery. If we see broad-based U.S. trade barriers, which the OECD seems to be hinting at, Japanese manufacturers lose direct market access and face margin compression. That's a material headwind for the cyclical recovery story we've been watching. On the flip side, the AI boom presents opportunities for Japan's robotics and technology sectors, but the competitive landscape is tough. U.S. and Chinese players dominate, so Japanese firms need to execute flawlessly to capture upside.
So how should investors think about the equity implications here? Is this a net positive or negative for the Nikkei and TOPIX?
It's genuinely mixed, and that's why we're seeing this consolidation. Export-heavy sectors like autos and machinery are vulnerable to tariff escalation, and those are significant index weights. We could see multiple compression in those names if tariff rhetoric intensifies. But technology and robotics plays could catch a bid from AI tailwinds, especially if Japanese companies can carve out niches in industrial AI or automation. Near term, I'd expect volatility as the market tries to price these conflicting signals. The key will be whether global demand holds up despite tariff friction.
And what about the yen in this context? Tariff fears typically support safe haven demand, but AI optimism might work the other way.
Exactly, that's the tug of war. If tariff escalation triggers risk-off sentiment, the yen should strengthen as a classic safe haven. But if the AI narrative dominates and supports broader risk appetite, that could weigh on the yen as investors move into higher yielding or growth-oriented assets. A prolonged global slowdown from tariffs would limit yen upside because it undermines Japan's own growth prospects. So it's not a straightforward safe haven play anymore.
On the policy side, does this OECD warning change the calculus for the Bank of Japan or the outlook for JGB yields?
It complicates things. Tariff-induced global growth concerns would typically compress yields as investors price in weaker demand and lower inflation. But the BOJ is already navigating a delicate path between maintaining accommodation and managing inflation expectations. If tariffs feed through to higher input costs or if domestic inflation remains sticky, the BOJ may have less room to ease, which could provide some floor under yields. The net effect will depend on whether growth concerns or inflation pressures dominate, and right now that's genuinely uncertain.
Staying with the energy theme, oil prices have been steady recently, and today crude was up just over 0.5%. Reuters reported that markets are balancing geopolitical supply risks with demand uncertainties. Given Japan's heavy dependence on imported energy, how are you reading this?
Oil stability is actually a mixed blessing for Japan. As the world's third largest economy and a massive energy importer, Japan is structurally short oil. The country has a persistent trade deficit in energy, so price stability is preferable to sharp spikes, but elevated levels still pose challenges. Geopolitical supply risks, whether in the Middle East or elsewhere, directly threaten Japan's energy security. And while today's move was modest, sustained elevated prices keep input costs high, which pressures corporate margins and feeds into inflation dynamics.
So how does that translate into market impacts across equities, the yen, and yields?
For equities, it's sector-dependent. Energy importers and refiners face margin pressure from elevated oil prices, so utilities and some industrials could be under strain. But exporters, especially in autos and electronics, might actually benefit if higher energy costs support yen depreciation, boosting their competitiveness abroad. Cyclical sectors are most sensitive to these crosscurrents. On the yen, steady oil prices don't provide an immediate catalyst for big moves. But if geopolitical premiums persist, they keep inflation expectations elevated, which could limit BOJ accommodation and paradoxically support the yen through higher real rates. For JGB yields, elevated oil prices increase domestic inflation risks, creating upward pressure on the long end. However, geopolitical uncertainty also brings safe haven demand for JGBs, so you get offsetting effects. The net impact depends on how persistent these energy cost pressures are.
Shifting back to the U.S. side of things, Wall Street futures inched higher today as markets continue to assess the Federal Reserve's next steps. There's clearly ongoing uncertainty about the Fed's rate trajectory. Why does that matter so much for Japan?
Fed policy is absolutely central to Japan because it drives global capital flows and risk sentiment. A more hawkish Fed, keeping rates higher for longer, typically strengthens the dollar and widens the interest rate differential between the US and Japan. That supports USD JPY strength, which we've seen in the recent trading range around 156. Conversely, if the Fed signals a dovish pivot, rate cuts or even a pause, that supports risk on sentiment globally, which can benefit Japanese equities through improved growth expectations and potential yen weakness. So the Fed's next move is a key variable for anyone positioning in Japan.
And specifically for the yen, how does the carry trade dynamic play into this?
The carry trade is still very much alive. As long as US rates remain significantly higher than Japanese rates, there's an incentive to borrow yen at low cost and invest in higher-yielding dollar assets. That structural flow supports USD JPY strength. If the Fed surprises with a dovish turn, you could see some unwinding of those positions, which would weaken USD JPY. But given current Fed messaging, that seems like a lower probability scenario in the near term. The more likely risk is that the Fed stays restrictive longer than markets expect, which would keep upward pressure on the dollar-yen pair.
And for JGB yields, I imagine U.S. Treasuries remain a key anchor?
Absolutely. U.S. Treasury yields are a global benchmark, and JGB yields tend to move in sympathy, especially on the long end. If the Fed's next steps push Treasury yields higher, we'd expect upward pressure on JGBs as well. Conversely, if the Fed signals easing, that would likely pull yields lower across the curve. The BOJ's own policy stance matters too, but the Fed's influence on global rate expectations is the dominant factor right now.
So pulling this all together, what are the key themes global investors should be watching as we move through the rest of this week?
I'd say 3 big themes. First, the interplay between tariff risks and AI opportunities, especially how Japanese exporters and tech firms navigate that duality. Second, energy prices and geopolitical supply risks, which directly affect Japan's inflation outlook and BOJ policy space. And third, the Fed's rate path, which is the single biggest driver of USD, JPY and risk sentiment globally. Those three forces are shaping the consolidation we're seeing today, and any shift in one of them could break the range.
That's a very clear framework. For our listeners tracking Japan exposure, these are the variables to monitor closely. No specific buy or sell recommendations here, but understanding these dynamics is essential for positioning. If you found today's discussion useful and you follow Japan's markets regularly, consider subscribing to TOI Japan Market Radio. We'll be back tomorrow with another briefing. Thanks for joining us.
Thanks for having me.